The McCormick Company Inc. New York Stock Exchange, symbol MKC, is currently trading at $65.71 as of this live intraday check on Wednesday, November 12, 2025. This reflects an increase of $1.40, or 2.18% since the previous close, a fairly strong move for a consumer staples company like this, especially considering the broader sector's recent sluggishness. Now, the common expectation when looking at McCormick is to see a defensive, sleepy stock, the ultimate safe harbor of spices and seasonings, a dividend aristocrat that simply churns along, impervious to most economic cycles. That's the narrative. But the unexpected reality hiding beneath this calm surface is the stock's recent dramatic underperformance and the very real tension between its volume growth and its profit margins, which has institutional investors on edge and sets up a high-stakes scenario for the next few quarters. The stock has been under significant pressure, hitting a 52-week low recently, and this current jump is less a sign of fundamental health and more a sharp technical rebound or an overreaction to minor positive news, making it critical to understand the deep-seated issues that are challenging the safe assumption. The general belief, particularly among the kind of investors who gravitate toward platforms like Fidelity or utilize a Schwab Intelligent Portfolio for stability, is that McCormick is a quintessential defensive play. Everyone cooks, everyone uses spices, and that demand is inelastic, right? This core business, selling Frank's Red Hot, French's Mustard, and their eponymous spices, provides stability that other parts of the market, like the volatile names of Tesla stock or Nvidia stock, simply cannot match. This expectation of stability is deeply challenged by the reality of the price action over the last year. The stock has dropped more than 14% over the past 12 months, moving largely against the trend of many broader defensive indices. Why? The market is actively punishing the company not for a lack of sales, but for a decline in profitability, which is the lifeblood of a defensive staple. Their recent third quarter 2025 results illustrate this perfectly. They reported a sales increase of 3% and organic sales growth of 2%, which beat analyst expectations. Volume growth was actually led by the consumer segment, which is a big positive and confirms the strong underlying demand for their products. However, the true tension point, the one that caused the stock to dip after an earnings beat, was the 130 basis point contraction in gross profit margin. This margin erosion is the direct result of higher than expected commodity costs, new tariffs, and the investment required to build capacity for future growth. The market, in its relentless focus on quarter-to-quarter efficiency, saw volume growth as a vanity metric next to the fundamental problem of profit compression. This dynamic creates a genuine contrarian take. The stock is cheap not because demand is weak, but because cost inflation is temporarily outrunning their ability to raise prices or cut costs, which for a seasoned company like this is a solvable problem over the medium term. Looking at the recent trading activity, the daily swings have been dramatic for a company in this sector. For instance, the day after the October 7, 2025 earnings report, the stock saw a notable drop as the market digested the margin guidance update. Volume spiked on that day, indicating a significant rotation out of the stock by short-term holders who prioritize immediate bottom-line results. However, institutional ownership remains exceptionally high, nearly 90%, which suggests that the big players, the mutual funds and ETFs that form the backbone of many Fidelity ETFs and Fidelity mutual funds, are largely holding their positions, viewing the cost pressures as temporary. The institutional activity over the past 6 months, which saw a nearly even split between increased and decreased positions, totaling millions of shares traded, confirms the high-stakes debate happening behind the scenes. Are these cost pressures secular, long-term, or cyclical, short-term? The market is currently pricing in the secular view, which explains the stock's depressed price. For a self-investing individual using a tool like SoFi Active Investing or the Robinhood app, this disconnect between solid volume and poor profitability is where the actual research begins, moving beyond the simple headline numbers. Even insider activity has been mixed, with a 10% owner selling a significant block of shares after executing options in early October, often interpreted as a negative signal, though it may just be diversification or tax planning. McCormick's business model is generally very straightforward, operating through two primary segments: consumer and flavor solutions. The consumer segment is what most people know: spices, seasonings, and condiments like Frank's Red Hot and French's Mustard on grocery store shelves, which is a great, stable asset for a diversified individual brokerage account. However, the flavor solutions segment is the more industrial and often underappreciated part of the business, selling ingredients and flavor systems directly to food manufacturers and food service businesses like quick service restaurants. This flavor solutions segment has been a strong area of growth, but it's also where the commodity and supply chain costs hit the hardest, as their contracts with large customers often make it difficult to immediately pass along price increases. Historically, the company has grown through strategic acquisitions, such as the acquisition of Cholula Hot Sauce and Fona International, which bolstered its flavor profile and industrial offerings. Their balance sheet is manageable, and their dedication to their dividend, now having paid a consecutive dividend for over a century, makes it a darling for income-focused accounts like those holding Fidelity IRAs. This stability, demonstrated by this multi-decade dividend commitment, often reassures investors that even during choppy trading, the core enterprise is sound. The broader sector context is crucial here. The S&P 500 Consumer Staples Index has been relatively flat to down over the last year, reflecting a general slowdown as consumers face persistent inflation and begin to trade down or seek private label brands. McCormick is not isolated in this environment. However, their acquisition in Mexico, announced in August 2025, to increase their stake in McCormick de Mexico to 75%, is a strong catalyst that many have overlooked in the noise of the earnings report. This acquisition, which is expected to be accretive to sales and profit, significantly strengthens their position in Mexico's high-growth market, increasing the contribution of their condiments and sauces portfolio to their total sales. This move is a tangible step toward long-term international expansion and diversification away from the sometimes stagnant North American packaged food market. The market's initial reaction largely ignored this strategic future growth in favor of dwelling on the immediate cost problem. This is a classic tension between short-term pain and long-term gain. For the future outlook, there are several scenarios to consider. The most bullish scenario involves inflation moderating faster than expected, allowing McCormick's extensive cost savings initiatives, their comprehensive continuous improvement program, to finally catch up and expand gross margins significantly. If commodity costs stabilize, the strong volume growth they've already demonstrated will immediately translate into higher profits, potentially pushing the stock back towards its 52-week highs. A less optimistic scenario involves stubborn inflation and increasing global tariffs, which could force them to choose between further margin compression to maintain volume or aggressive price increases that risk volume loss as consumers continue to pinch pennies. The risk here is that the defensive appeal wears off if profitability doesn't return to historical norms. The opportunity lies in their commitment to flavor innovation and their flavor solutions segment, where they partner with major food companies. As CPG companies reformulate and innovate their own products, McCormick is perfectly positioned as a flavor leader to capture that industrial growth. Platforms like interactive brokers are often used by traders who want to capitalize on these macro shifts, trading the long-term trend against the immediate volatility. The key, whether you are using online investing tools or seeking detailed investment help, is recognizing that the stability of the consumer staple sector is being stress-tested by inflation, and McCormick is currently at the center of that test. The ultimate question for investors is whether they believe management can effectively execute their cost savings programs and integrate their new international acquisitions before the current price pressure fundamentally alters the company's defensive reputation. Comment below with your thoughts. Do you think inflation for essential food commodities like spices and packaging will ease significantly in the next 12 months? Or will McCormick continue to be squeezed? Your answer to that question is the biggest indicator of your personal forecast for McCormick stock. In summary, the market's initial expectation for McCormick was that of an unshakable defensive giant, a reliable anchor for any portfolio, the kind of name that underpins a stable growth strategy at Fidelity Investments or for a user doing self-investing on a new platform. The reality, however, is a company facing a